We are kicking off a brand new series today, doing a deep dive into one of the most important and often misunderstood concepts in accounting, cost of goods sold, or COGS. But instead of a generic overview, we are going to tackle it sector by sector, and we are starting with a big one that many of you have asked about: real estate. Why real estate? Because depending on what you do in the industry, whether you're a house flipper, a land developer, or a real estate agent, the way you handle your cost is completely different. What one person calls cost of goods sold, another must call an operating expense. Getting this right is fundamental to understanding your true profitability. Today, we are going to clear up all that confusion. By the end of this video, you will be able to confidently identify and calculate the direct cost for any real estate business. If you're ready to build a real foundation in real estate accounting, let's get started. First, let's establish a crystal clear definition of cost of goods sold. Imagine you're a baker. Your cost of goods sold for a cake isn't your rent or your marketing. It's the cost of the flour, sugar, and eggs that went into the specific cake that you sold. Cost of goods sold represents the direct cost tied to producing or acquiring the goods that a company has sold. The reason this is so important is because it allows us to calculate our gross profit. Gross profit tells how profitable your core product is before you even consider your general business overhead. It's the most fundamental measure of your business health. The key question we must always ask is, what is the direct cost of the specific thing I sold? In real estate, the thing is the property itself, but who is actually selling the property they own? This is where we need to break it down by role. Let's start with the clearest example: the house flipper. A flipper's business model is to buy a property, which is their inventory, improve it, and sell it for a profit. For a flipper, the house is their product. So, what goes into a flipper's cost of goods sold? It's every cost that is directly traceable to acquiring and preparing that specific house for a sale. In accounting, we say these costs are capitalized. This is the process of adding a cost to the value of an asset on the balance sheet rather than expensing it immediately. Think of the house as a mixing bowl. Every direct cost you had is another ingredient. These ingredients include: first, acquisition cost. This is the starting point. It's not just the purchase price, but also any cost to close the deal, like title fees and legal cost. Second, renovation and improvement cost. This is the big one. It includes all materials like lumber, paint, and fixtures, as well as any direct labor you paid for the renovation. Third, direct holding costs during the renovation. This is a key detail. Costs you incur while the property is being prepared for sale are also capitalized. This can include property taxes, insurance, and interest on a project-specific loan during the renovation period. Let's walk through a full example. Imagine a flipper buys a house. First, they purchase the property for $200,000 and pay $5,000 in closing costs. On their balance sheet, a new asset called property inventory now appears with a value of $205,000. Next, they renovate. They spend $40,000 on materials and subcontractors. They also pay $5,000 in property taxes and insurance during the 4-month renovation. These costs are added to the asset, increasing the property inventory value to $250,000. Finally, the sale. The house is now ready and sells for $330,000. On the income statement, the sales revenue is $330,000 and the cost of goods sold is the total capitalized cost of $250,000. This gives them a gross profit of $80,000. When the sale happens, the entire $250,000 moves from the balance sheet as an asset to the income statement as cost of goods sold. General business expenses like marketing, a website, or office rent are not part of cost of goods sold. Those are operating expenses. A real estate developer is very similar to a flipper, just at a larger scale. Their key challenge is cost allocation. Let's walk through an example. A developer buys a 10-acre plot of raw land for $500,000. Their goal is to create a subdivision with 10 individual 1-acre lots. Over the next year, they incur several capitalization costs to develop the entire project. This includes fees for surveying, cost for grading the land, paving roads, installing utilities like water, and landscaping the common areas. Let's say this development costs total $350,000. Now, let's calculate the total cost basis for the project. We take the original land cost of $500,000 and add the development cost of $350,000. This gives us a total project cost or inventory value of $850,000. Since there are 10 lots, the cost basis per lot is $85,000. The developer's total developed land inventory on their balance sheet is $850,000. Now, let's say this year they sell 3 of the 10 lots. What is their cost of goods sold? It's 3 lots sold multiplied by the $85,000 cost per lot, which equals $255,000. Their cost of goods sold is only the cost of the lots they sold. The remaining inventory of $595,000 for the 7 unsold lots stays on their balance sheet as an asset, ready to be sold next year. A real estate agent does not have a cost of goods sold. Why? Because they are a service-based business. They don't own the house. They are providing a professional service to facilitate a transaction in exchange for a commission. So what is their biggest direct cost? For a brokerage, it's the commission split they pay out to their agents. Instead of cost of goods sold, a brokerage has a line item on their income statement called cost of sales or cost of revenue. It serves the same purpose, measuring the direct cost of generating that revenue. Let's look at an example. A home sells for $500,000. The brokerage earns a 3% commission, which is $15,000. This is their revenue. The brokerage has a 70-30 split with the agent, so it pays the agent 70% of that commission, which is $10,500. This is their cost of sales. On the brokerage's income statement, this would look like revenue of $15,000 minus a cost of sales of $10,500, giving them a gross profit of $4,500. General expenses for an agent like marketing, MLS fees, or insurance are all operating expenses. So let's summarize the key difference.
For a house flipper or developer, they have a true cost of goods sold. It includes the purchase price plus all the development and renovation costs of the property they sold. For a real estate agent or broker, they do not have cost of goods sold. They have a cost of sales, which is the commission split they pay to others. And for a landlord with rental property, they have operating expenses like repairs and depreciation. They only have a cost of goods sold event if and when they finally sell the building. The golden rule is this: you only have a cost of goods sold if you're selling a tangible asset that you previously owned and held as inventory. If you're providing a service, you have a cost of sales or cost of revenue.
And that's how cost of goods sold works in the world of real estate. A simple concept, but with very important differences depending on your role. Thank you for joining me on this deep dive. If you learned something new, give this video a like and be sure to subscribe for the next one in the series. I'll see you then.